Welcome to Class 12 Spyker car presentation. I am James, and as part of my team, ASEC Group, we are presenting to you our case presentation, Spyker Cars. Spyker was developed in the year 2000 after Spyker's Cars NV acquired the rights to the brand name. 3.5 years later, the company offered share for public trading in May of 2004. Spyker follows a differentiation approach. They have a reputation for high-quality engineering and production, and develop hand-built sports cars and related products for the high-end sports cars market, with a high-end distribution network to match. Currently, they have 5 different car models for sales, which have proved very popular with the customers, and have resulted in a large backlog of orders due to the limited production capacity available to the company. However, the company is taking steps to increase its production capacity in order to meet demand.
In order to perform evaluation of the phone, first the 11-step forecasting approach discussed in payment has to be followed. The sales growth rate was estimated at 175% in the short run and 35% in the medium term, and revert to 8% in the long run. The company is expected to benefit from the aging population in the coming years due to post-war body boomer reaching their peak level of purchasing power. Furthermore, Spyker's entrance into a new market segment, the luxury sports utility vehicle segment, is also likely to benefit the company's sales. In the long run, sales growth tend to revert to approximately 8% and remain relatively stable at this point. The asset turnover ratio tends to be relatively stable for most companies, except for firms in industry where asset turnover is very high, in which case it tends to decline and then stabilize. Spyker's asset turnover for 2005 was 0.21, which is determined by dividing sales revenue by total assets. Although the company purchased a new 12,000 square meter production plant in March 2006, which would reduce the expected asset turnover due to the very high sale growth. Asset turnover is expected to increase to 0.5 in 2006 and remain stable at this ratio indefinitely. Net operating asset is then calculated by dividing sales by the asset turnover ratio. Although Spyker's profit margin was negative 20% in 2005, it is expected to increase to 8% and remain at this level indefinitely. Profit margin is expected to increase to this level due to the large rise in sales revenue. Outsourcing of the bodies in white production to the Germany-based company is expected to decrease the cost of production for Spyker. Hence, the improved profit margin. Furthermore, international expansion will generate more sales for the company.
Spyker's free cash flow is forecasted to be negative in every year, which suggests that the company's investing cash flows are larger than their operating cash flows, reflecting the fact that Spyker is making large investments to expand capacity. It is advised that the company should issue either debt or equity in order to raise financing funds. The current dividend payout ratio is 0, as Spyker's short operating history, during which it has not made any profit, means that the company has been unable to pay any dividends. Due to the negative free cash flow forecasted, no dividends are expected to be paid in the future. The final assumption required for forecasting is the cost of debt after tax. This is estimated as 3.7%, which is in line with the figure found in the reformatted financial statements. The residual income model has been utilised in order to value the company and compare this to the current share price. Research has shown that this model can outperform other valuation models. This is because abnormal earnings focuses on value drivers such as profitability and growth from investment. In addition, it incorporates the balance sheet with reference to the book value of equity. The model also uses accrual accounting rather than the cash accounting, which recognizes value added and treats investments as an asset. However, it also requires extensive knowledge of how accounting works and how to make adjustments to reflect economic reality.
A number of assumptions must be made when using this model, including the cost of capital for equity and the terminal value growth rate. The cost of capital for equity is calculated using the capital asset pricing model, which calculates the expected return of an asset based on its beta and expected market returns. Beta is a measure of volatility of systematic risk of an investment in comparison to the market as a whole. Spyker's beta is assumed to be 1, which is approximately the same as a competitor Porsche and indicates that the company's stock price is expected to move in line with the market. The risk-free rate is also required and can be estimated using the interest rates on government bonds with a maturity of 10 years. The risk-free rate is estimated as 3.4%. Finally, the market risk premium rate is also required. This is the difference between the expected return on a market portfolio and the risk-free rate. As the company's cost of capital is 9%, which is given by the question, this would suggest that the market risk premium is equal to 5.6%. Spyker's primary market is the US, 39%, which experienced an average annual GDP growth rate of approximately 1.68% between 2004 and 2014. Their second largest geographic segment is Europe, 27%, whose average annual GDP growth rate was 1.16% between the same period. The third largest geographic area is China, 15%, whose average annual GDP growth rate was approximately 10%. The terminal value growth rate is expected to be 4%, which was given by the question, and suggests that Spyker is expected to outperform the majority of the economies in which it operates in.
Using the residual income model, the share price has been calculated by us as to be $18.26, which is lower than the current share price of $18.50. This suggests that the company is overvalued and investors should hold their stocks in Spyker, considering that the forecasted valuation is only slightly lower than the actual share price. This may fluctuate in the future. Additionally, due to the uncertainty surrounding a number of the assumptions we used in forecasting and valuation and the other limitations of the model, the actual value of the company may differ greatly from that we forecasted. That's our conclusion. Thank you very much. Thank you, Professor N, for guiding us, and thank you, everyone.